Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is your starting lineup for the 3 in 10 podcast on Friday, August 15th, 2025. Number 1, the Great Rebalancing. The U.S. and China are incentivizing major changes in their economies at the same time. Number 2, Deere, down on the farm. Deere reports a disappointing second quarter and the stock falls significantly. And number 3, Jackson Hole, teeing up a September rate cut or a nasty surprise for complacent markets. Now back to number 1. The world's 2 largest economies are rebalancing at the same time. What could possibly go wrong with that? The U.S. is taxing imports and consumption while subsidizing production. China, on the other hand, is subsidizing consumption, continuing to subsidize production, and increasingly subsidizing technological innovation. These are tectonic changes with potentially huge implications. Both the U.S. and China are running massive fiscal deficits. The U.S. has been running 6 to 7% of GDP deficits since COVID. China, on the other hand, has started to ramp up their fiscal deficits. The official projection for China for 2025 is minus 4% of GDP, but private sector estimates are anywhere from 7 to 10% of GDP. So this is costing China a lot of money to stimulate consumption and everything else. The seemingly existential race for AI supremacy will invite further subsidies, in our opinion. There will be winners and losers, of course, in these tectonic shifts. We detail our conclusions in our latest report released last Wednesday entitled The Great Rebalancing, and we encourage you to look for this on our website. Now on to Deere. Net sales and revenues were down 9% year over year. Agricultural sales were down 16% year over year. Management cited lower shipments and lower prices. Obviously, that's a difficult combination for any company. Demand was pressured in ag by high interest rates, elevated inventories, trade uncertainty, and lower crop prices. All of those things have impacted farmer confidence. And when they don't have confidence, they don't buy new machines. Construction markets, on the other hand, remain pretty stable. The U.S. government infrastructure spending remains very robust and is likely to continue for the next several years. That's part of the reason we're running these large deficits. I wanted to listen to what the management of Deere had to say about tariffs, because in the second quarter, I'm sensing that tariff costs are starting to flow through the income statement for some of these large cap multinational industrial companies. This is where we're seeing it first. So tariff costs were $200 million in the second quarter, and they're expected to be $600 million for all of 2025. That's real money where I come from, $600 million. Tariffs are especially hurting them. The tariffs on Europe and India, steel and aluminum are where tariffs are really hitting Deere. I went back and I looked at crop prices, specifically soybeans and corn. Soybean prices are flat this year. Corn prices are down 45%. From the April highs. Of course, there's some seasonality there. But I went back to 2022, and both beans and corn are both down almost 50% from the highs in 2022. So farmers are hurting, and China is buying less and less of these 2 key commodities for U.S. farmers. This is exactly what happened in 2018 when Trump first put on the tariffs on China. They stopped buying agricultural products because they recognize that farmers are a key part of his political constituency. Farmer costs are up for fertilizer, for seeds, and for pesticides. Another margin squeeze for the U.S. farm economy. And of course, farmer confidence is down on this. So the farm economy is under pressure in 2025. That's the bottom line that I took away from this Deere call. I expect government money to increasingly be heading to the beleaguered U.S. agricultural sector later this year. The farm economy is now a relatively small part of U.S. GDP, but politically, the farm economy punches way above its weight because it's a key part of the 7 battleground states that typically decide U.S. presidential elections. So now, on to number 3, Jackson Hole. The Kansas City Fed will host its annual symposium next week, August 21st through the 23rd. And interestingly, the title of the symposium is Labor Markets in Transition. We think there might even be a clue embedded in that title, that labor markets are becoming more important in the minds of most of the Fed governors. This event has the potential to surprise complacent markets, in our opinion. We're now in the heart of the weakest seasonal for the equity markets, and we know that late August and mid-September tend to be the weakest times of the year. So lightning could strike at Jackson Hole. It certainly has before over the last 25 years. But we expect the Fed to validate expectations for a September rate cut. Markets are still pricing an 85% chance of a 25 basis point rate cut on September 17th. When I looked at the data this week, the core CPI and core PPI were both disappointing. Inflation's still running too hot, especially in services, which were the major culprit in both of those releases this week. Services inflation just continues to run too hot. So I think a policy mistake could easily be made in either direction for the Fed. On one hand, if they don't cut fast enough and big enough, the U.S. labor market, which is clearly cooling, could tip over into recession and put the U.S. economy into a recession. On the other hand, if they cut too fast and too aggressively, U.S. inflation could reaccelerate, especially with tariffs starting to come through. So the Fed is in a very difficult position. And I think Jackson Hole is very well timed to give us some clarity on what they're thinking. And we expect further clarity and expect a dovish tone coming out of Jackson Hole, which would not be a great surprise. It would be supportive of further gains in equities and maybe even bonds. But I think the key point that's going to come out of Jackson Hole is that the labor market is assuming greater importance over inflation concern. So there you have it. That's your 3 in 10 podcast for Friday, August 15th, 2025. And as we always say, do the work, endure the pain of gain, and have investment courage.